Well, good morning, everyone. This is Glenn Thompson, and I guess we should start. It's just about 4 minutes after 10 in the morning Pacific time. And once again, welcome. My name is Glenn Thompson, uh, and I'm representing Pacific Trading Academy. If you'd like, and we are recording today's presentation. So if you come in late, or if you'd like to review it, we put the recording on our website and other places for just to get the word out. You can reach us at 800-339-8588. You can also take a look at the website, www.pacifictradingacademy.com. Peter Newman handles admissions and is available. He would be the person directly responsible for a lot of what I do and my coworkers and other mentors. Today's topic, emotional states of trading, and let's just progress the slide presentation so we can move on. Up, right there, okay. And I was thinking earlier today, this is a rebroadcast more or less of the similar presentation I gave back in May, and about an hour or so ago I was just trying to think of any new embellishments or twists that I might present as an initial overture to the topic. And it really is a thought, or there is this thought that if it weren't for the impossible complexities in the analysis part of trading and speculation, there would really be very little, if any, need for consideration of psychological components and emotional aspects of this business. But because we don't have perfect understanding of the formulas and the equations that define and direct market behavior, there is an extra need for more as an adjunct ancillary assisting tools, such as any construct that can help us in our thinking and our reactions emotionally and cerebrally to our attempts to profit from financial market behavior. We just don't perfectly understand the systems. They are implicit and embedded with a spectrum of paradoxes, and it's these paradoxes that create the frustrations we often have in our attempts to, when we fall short of our objectives in our attempts to profit consistently from speculative activity. So thus the need for the whole kind of field of trading psychology and psychology in general. It's to assist us emotionally in our effort, sort of as a complement or simultaneously to our analysis. So thus, let's move forward, and I'll give you some insights I've thought about and learned over the years. I have been actually just a little further on the commercial, and then I'll get started here. I've been trading with or working with and teaching with Pacific Trading Academy now since the beginning, 15 years ago, or it's actually, I guess, going on, I've lost track. It's between 15 and 16 years. I've actually been in this business about 34 years. Most of my career was back east in the New York area and New York metro area, tri-state area, primarily on Wall Street. I started as a broker, and then I kind of over a few years later was able to kind of evolve to become a trader. So let's move on. Psychology, just some basic intro here. The scientific study of the human mind and its functions, especially those affecting behavior in a given context. So the context I'm going to focus on today will be that of investing in speculation. By the way, folks, in addition, just so you know, I have two trade ideas. One trade that we entered into, actually I got in it 2 weeks ago. For the people that I consult and teach and work with in my daily activity with Pacific Trading, I generated a signal this past week, and it's still these are position trades, and it's still a valid trade for those of you who are interested. And the other is coming up, actually I anticipate, based on all my best efforts and the type of analysis that I do, and I'll elaborate it at the end of the presentation today. It's a trade coming up, possibly due for entry in the next few days. And it is also a position trade. So I have some slides that are particular to the specific analysis part, because I know most of us are interested in that naturally. But the bulk of what I want to talk about starting right now is, again, it's not related to the analysis, but it is something I feel and have determined over the years is much, much more important. I realize that's not, especially when we're getting started, the primary view, but it is my view nevertheless. All right, that's what psychology is in a quick synopsis. Trading is an enterprise, trading. There's the analysis on the left side of the screen, and the point of analysis, the ultimate utility and objective analysis, is to try and find some good opportunities where we think we have some advantage. Where is there an opportunity where there is a disparity in probability that we can capture for our account, as it were, and to that extent it benefits us. We are capturing more monetary energy. Psychology, behavioral biases, there are cognitive biases that we can acquire, there are emotional. Cognitive biases are those in terms of an attempt to kind of identify flaws in our human psychology that we bring to this activity of attempting to interface with markets. We may have faulty reasoning. There's much more opportunity for mistakes than there are for perfect alignments with what is correct in a particular endeavor, especially in the investment area. So I find two major kind of subsets of origin for where we can acquire an improper internal state or psychology or the status of our viewpoint. Faulty reasoning. And then there's emotional stuff that just is more of a sensory nature, born of intuition opposed to conscious thought. So those are the two major types of biases and how they can arise. One is more cognitive, more cerebral, born of pure thought. It's just incorrect thought with respect to the activity we're attempting to interface with for the byproduct of financial return. The other is more sensory or emotional. Okay, more specifically, problems that can arise and create an incorrect or an inappropriate or not relevant internal state with regard to the activity of our attempt to interface with the financial system, such as a stock, bond, commodity, any freely traded market. To ascribe your success to skill or hard work. By the way, folks, let me just interrupt here. If you have questions or comments or anything you'd like to state, you can do so while we're progressing with the slide show, just writing it in the area on the control panel on the right side of your screen. If I'm able to kind of intermittently peruse that without breaking the flow, I will do so. If not, we have time at the end and I'll address any comments or questions you have. To ascribe your success to skill or hard work. To blame your failure on external factors or bad luck. Here, those are two problems that often traders, myself included, the very best traders and much less the worst traders or anywhere we are on the spectrum of success or lack thereof. The dangers of these things, obviously, if we don't perceive errors as errors, we can't learn from them. So, I don't know what I don't know is a real problem to this business. Or if I don't know what I don't know, that concept can create major pitfalls and lost opportunities in the process of my attempts to be profitable. Attributing lucky outcomes to skill can lead to overconfidence. This leads to overtrading and overtrade sizing, which are very specific mistakes traders can make by trading with a size, a number of units of exposure in a particular market at any given time that too large relative to the amount of fuel or resource, how much money you have, is itself problematic and is a component that would serve to decrease the length of time, the duration for which you get to enjoy this business. And that's an important concept. I cannot overemphasize this. The amount of time, anything and everything we can do that serves or has the end result, however directly or indirectly, of lengthening and stretching out the sample time, the runtime of your operation, your trading business, will ultimately, however minutely or however impactfully, improve your odds for success. You see, that's a very important concept. It's a subtle one, but critical, and I'll come back to that in a few minutes. This leads to overtrading and overtrade sizing. So if we have too large a position in any one market at any one episode in any one campaign, however, and all of these ideas, folks, apply if you're in all windows of time. If you're at the highest frequency of trading, an ultra high frequency trader, such that your average time in a position might be measured in magnitudes of nanoseconds or picoseconds or leptoseconds. To the opposite, if you're a long-term investor on holding positions for years, and obviously on the continuum of time windows in the entire spectrum from one extreme to the other, over trading and one particular way by which an obvious way of over trading is too large a size relative to the other variables that define your account at any given time. Very big problem. So we have to guard against it, is the point of the slide. All right. Overconfidence, which this is a kind of an intellectual or cognitive bias. An incorrect view is that a lack of confidence is holding you back as a trader versus acquiring and developing skill and learning to be confident in the skill. I know the field of psychology in general, and I've been just in a ancillary sense since I was probably in junior high school. I was always interested, at least peripherally, in psychology and things related to thought and mental activity. So I read a lot of the popular literature, and some of which is very helpful and very relevant and good, I think. So has good structure and sound basis in reality. I've always been interested in that. There is this view, it's a central theme of psychology in general, and in general that aspect of psychology in terms of the self-help portion of it. That was more or less as a kind of a subset of psychological literature, or the lexicon of psychology, and it's particularly the self-help component of it, that not having sufficient confidence can thwart and hinder and more or less dampen whatever you're attempting to do. And to some extent, I totally buy into that idea. However, again, when we're talking about the business of financial speculation, and again, we have to be very critical. Yes, that is true on the one hand, but let's never forget or assume that a lack of skill and lack of confidence, we got to keep them apples and oranges, separate. Neither one is going to serve you, is going to be, if you have a lack of either one of those things, and an inappropriately developed set of tools on the one hand, and I should say, a lack of internal confidence in the skill level that you've acquired or acumen you've acquired in a given model or idea or technique. In this business, we require for any attempt at achieving or getting close to optimal results, we have to have a commensurate level of confidence, but the confidence must be a consequence of a commensurate degree of skill that we've acquired over learning the forces and the relationships that are present relative to financial market motion and behavior. So what this is not saying, it's not saying that, or what the message I want to convey of this slide primarily is just merely making some affirmations and that are making you feel good and bolstering your internal picture. That's all fine and dandy, as they say, but to do so without the commensurate acquisition of an understanding of what are the forces of the system we're attempting to work in and with and upon and intermingle with, that's not going to enable you to usurp the maximum benefit from a positive internal state that's truly reflective of the best entity you are. In fact, it can create a degree of overconfidence that is unwarranted relative to your understanding of what it is you're trying to do. Overconfidence can lead to overtrading, and that's a consequence of this. Incorrect assessment of risks associated with extreme moves, both of which hurt the long-run outcomes. Again, notice the emphasis. I should have underlined long-run outcomes. That speaks to what I mentioned in the previous slide in terms of any and everything we can do to stretch out the runtime of our operation. The sample size and runtime, they are not exactly the same, but they're very highly correlated. The more times you get to flip the coin, or by analogy, or in this business, the more entries or round turn episodes of into the market and out, the more closely your activity begins incrementally to approach, as an asymptote as it were, the profile of performance of your methodology. Now, if you're implicit in this idea is that you are satisfied with your performance, your win-loss ratio. If you aren't, this is why it's important, it's imperative that we learn the business and learn the mechanics of market behavior, so we know how to construct models that are going to hopefully lead us more frequently than not to value areas in a market that we can exploit. Let's see. What is Sheth is asking, what's my view on automated computer trading for small day trader? This is a question I hear all the time from when I'm speaking, like in a presentation or even in a private one-on-one consultation. The process of automation serves like anything, there are pros and cons to any aspect of this. Automating something will serve, to the extent that it does, to diminish the positive of an automated system is it will tend to eliminate or diminish, at least, or curtail any negative emotional interference that a trader might enact on an otherwise robust model. I had a session just a few days ago with a person who is day trading, and they were actually a very adept at programming, computer programming, coding. And they were saying to what are the benefits and merits? We were discussing this very same idea, the merits of coding and automating a system. Insofar as it goes, it's fine. I'm all for automated systems, whether it's short-term day trading, small, large, any and all of the above, or if you're long-term trading. I am all for automation because of what I just stated. It will serve at its best to diminish the times when when an improper emotional state, what we're talking about right now, would serve to tamper with an otherwise robust system. And in fact, I had another conversation with someone just a few days ago where they were saying they entered into what they anticipated to be a short-term day trade based on a setup, a structured setup we had previously discussed. Everything was moving, and they were on I think a 60-second chart, or they started with maybe a 5-minute or a 4-minute chart. If I use a 4-minute chart for day trading on indices, for example, so I might have mentioned that. But in any case, they kept zooming or drilling down to shorter time frames. And when you do that, understand you're going to see, as you go down in time, in general, you will see a higher, or observe visually, you're able to observe and monitor and register higher amounts of granularity, greater detail. The resolution is greater. So you're going to see that. The response emotionally to your reception or cognition or receiving more detail, often, especially in day trading, may elicit the reaction. So much in our life, in the entire universe, and especially when we boil it down to this particular activity of day trading, for every action there is an equal and opposite reaction. There is also, especially germane to day trading in particular, I thought that more often than not I've found that doesn't have to be, but it can be deleterious to our ultimate goals, and that is the thought that passes through our thought stream of I need to be doing something. Never confuse activity with accomplishment, and that's a broad concept. It is so of critical importance in the overall activity of any type of investment or speculation or trading, especially in the short, as you get into shorter and shorter time frames. So again, the quick answer to the question, I am all for anything that will serve to diminish the impact of any or the potential problems that could arise by an improper interference on the part of something coming from our emotional componentry, our internal state, to interfere with a pre-set up or pre-configured plan. And this is one of the benefits, a systems trader slash computer trading, an automated trader, automatic algorithmic trading, etc. All of the variations on these themes, I think the advantage clearly is that they will at best serve to at least diminish or mitigate against human, the tendency for human interference, which sometimes can be good, but more often than not, because of an improper internal state, tends to hurt or harm overall an otherwise robust model. So my quick answer again is I'm for computer trading or automated trading. It's a tricky question. One might say, do I do it? I don't do it now because yes, that is the plus, but there's also, I don't know. Here's the quick opposite. Whatever you code is a function of whatever comes out of you, or whatever. Yeah, there's got to be the code in. What comes out is a reflection of what comes in. So it's only as good. Any automated idea is only as good as the input, is the potential problem or downside. So I won't. But essentially overall, assuming we can address that, I am for anything like computer trading or automated trading or algorithmic models, certainly. Okay, most important thing to remember is to stay in the game. Once you have an edge, if you can play long enough, the law of large numbers will eventually make you rich. Don't jeopardize your future trading. Yes. Now, this is a truth. It's a very simple idea, I think, if for most of you most of us to conceptually understand. And the issue is we've got to implement it. So we must keep this concept at the forefront of our mental kind of apparatus so that we're in constant view, more or less as a cue to remind us to do and to think those things and those thoughts and act those activities that will serve to prolong our activity so that we can flip the coin or engage in the process of entering and exiting financial systems more often, more frequently than less. Because to the extent we have more trials of investment opportunities is the extent to which we will more and more closely, ever increasingly approach, kind of get like an infinite series, get closer and closer to that precipice, if you will, of finality. We're going to more and more closely approach the performance ratio. And to the extent we do that, we're getting closer and closer to reaching a specified financial objective, a goal. All right. The availability heuristic, tendency to base decisions on the first piece of evidence that comes to mind. I am very guilty, have always been, and still am, of this particular emotional behavior, I guess. Estimation of the likelihood of events on the basis of how easy those events are to imagine. I am quick to admit, just for to myself, so that I can constantly enact or at least attempt a compensatory mechanism, however I'm able to do so. But I'm quick to admit to myself, and I will now for the purpose of highlighting and emphasizing the importance of this potential problem. I am one who constantly, on any given day, at any given moment in the day, I have the greatest new idea, so to speak. I always come up with bright ideas, quote unquote. I don't know how bright they are, but at the moment, in the moment, they seem to be quite bright or, earth-shattering, if you will. Very often, I'm humbled by virtue of putting these first thoughts into an action or into a trade. By skipping through the steps and just from thought immediately into the market. Sometimes they work out, more often than not. I'm not saying that what this ability here, availability, I'm not suggesting, or this concept is not suggesting in a generalized sense that just any initial idea is always going to not work out, will never be good or appropriate or relevant. It's not saying that. What it is saying is check it out, run it through. Don't assume that the very first quote unquote great idea you derive is ultimately the most optimal, perfect, relevant concept. You had what basis for comparison if it's just the initial idea or concept or manufactured view in what would otherwise be a sequence. You have no basis for comparison. So unless somehow intrinsically you are the statistical outlier, or the idea is that is an atypically, unless it's so luminescent that it's earth-shattering, then it warrants a comparative evaluation, is what this slide is suggesting. Tendency to base decisions on the first piece of evidence that comes to mind. It's kind of by analogy, if I were to generalize it, folks, in everyday living. What do? One should be a comparative shopper, I guess. You don't, when you go in the store, buy the first item that looks good. I mean, one could, I think, is what this idea is saying, but you often, over the longer course of shopping, would probably end up being more successful at that enterprise if you did some comparison shopping. And so in terms of ideas that we can apply to our trading, be very careful not to immediately, with all of your might, seize upon the very first idea. Run it through the comparison mill, if you will, by virtue of juxtaposing it to alternate ideas. And then if it still makes it through that filter, then you may have something more that has at least been tested by virtue of comparison. That's all this concept is suggesting. All right, short-term thinking, the irrational preference for short-term gains at the expense of long-term performance. When I think about this, what this is not, I always use options and the options trader and the options paradigm as an example to make the point. What I am not suggesting, because a lot of beginning options traders, because of the industry and the constructs and the internal certain viewpoints that have been propagated and pumped up and ramped up, and prevailing modes of thought. There are various entities and what I refer to as energy bastions of energy centers that espouse certain views. One of the things that you want to do that will serve you well, no matter what type of speculator and market operator you are, whether you're trading underlying, whether you're trading a derivative, whether you're trading derivatives on derivatives, whether you're trading stocks, bonds, commodity, you name it, any asset class, any financial instrument that is freely flowing, in a sense, freely marketable entity, deserves, in order to play it right and exploit it for all it's worth over the course of a series of opportunities that you as an operator may have, deserves a full spectrum of your consideration. So I'm going to use options. There is this prevailing view I have found just in talking to so many traders over the years, when they get into options. And again, what I'm saying right now is not strictly speaking to options. I'm just using the options arena as a means of highlighting the point this slide is making, and that is this. After people get a little foundation of knowledge in the options markets and how they work and the mechanics and the parameters that are intrinsic to them, there is this, I have noticed, because of the mechanics of the market and the peculiarities or the features that are peculiar to the market, I found that there is a general preference for shorting or selling options versus buying options. And it's funny because when I first started trading options, just to give you some context here, I remember at about 25 years old first learning about the options markets, and my immediate response to selling options because of the potential for open-ended exposure, especially on the call side, limited on the put side, but was immediate repulsion. How could anyone do something that again. And then then I moved from that point to realizing, once I learned about, then I began to have greater acceptance of the sale or shorting or writing of option premium as I learned a little more about it. And then I went to that extreme, and I think so. That's what where I want to make the example. Because there are more maybe market states that are consistent with a short option strategy being profitable, then there are a similar number of states that are equally favorable to a long option play. Because that is the case in a specific that specifies a peculiar or a feature peculiar to options in general. Because of that, there is this viewpoint that has been developed over years, maybe, where for beginning options traders, they seem to think that the only way to make money in that arena is by selling options, when in fact statistics clearly indicate the larger sums of the traders, for that faction or section or fraction of options traders that are truly successful, now that I need to qualify that. Where is the threshold of what I'm calling truly successful? But the big institutional traders that make very large returns in options primarily, or the majority of them, are doing so not via short-term strategies. Now, I'm not saying you can't. I'm just saying statistically, on the institutional level, there is a preponderance of data that shows, in terms of a certain threshold of percentage return, above it, it's primarily the larger percentages are due to long option plays. And to me, that's, at this point, I kind of intuit that. Now, what I'm not saying is that you cannot be successful in writing options and short option strategies. I'm not saying that at all. What this slide is saying is, I'm just using, in a broader sense, we often look to the immediacy. This slide is really more deeply, the essence of what this point is making is, we are very immediate centered in everything in our life. And if you think about the pace at which information flows in the world today, it's no wonder. We are an instant society. My biggest pitfall as a trader has always been, and still is, my impatience. And this irrational preference for short-term results, gains of which are one type, is born of that impatience. And the impatience probably has to do with the rate at which we are moving in every respect in our day-to-day life through time, in a sense. But we have to be careful, because that can be a hindrance in terms of limiting our thought process and our thought stream and our series of thoughts to only looking for shorter term or short-term windowed time horizons. We got to be careful against that. Loss aversion, emotional. This is clearly an emotional bias, and no doubt shaped by the pressing need for energy in our life. And we've, in every respect, from morning dawn to dusk, sun up to sundown, 24/7, everything in this universe, in this realm, as I am aware, more or less, unless we're in some kind of extreme singularity, like a black hole, barring that, everything requires energy. The form of energy, the primary currency of energy in the universe worldwide, is money, as we know it. So in order to consistently win over the long term, it's necessary to accept losses. Well, that flies right in the face of what I just said. Let me repeat this. This is getting really to the heart of why it is so challenging, if it is. I hope it's not, but for most of us, we bring to this activity of speculation our internal state, which has been shaped and massaged and formed and sculpted by every interaction it's had in everything that we do 24/7. We're humans before we're traders. Even if in any possible manifestation or permutation you could think of, if you have created a computer program, speaking to the automated algorithmic type trader, ultimately that becomes an entity. It's a participant in the market if it's automatically somehow in an AI way generating signals. ultimately at its original starting point or point of origin, there was a human. There is a consciousness there. If you think you can take this to the limit as far back as you want to drill, even if it's silicon based, there had to be some conscious. It might be silicon based. You know, I can project in 10, 20 years from now, there will be maybe a supplementary or a complementary intelligence, or an intelligence that's maybe not carbon based or organic as we know it. It might be silicon. Nevertheless, there is a starting point of consciousness. And so there is this emotional, there would then be an internal bias or a state of that silicon consciousness. Whatever the starting point is, we must ensure that the internal state dovetails and resonates appropriately with the system that we're attempting to get into or on board for the purpose of the corresponding byproduct of extracting a energetic return, i.e. money. So in order to consistently win over the long term, it is necessary to accept losses. Let me repeat that. This is getting to the heart of the whole program today. In order to consistently, if you want to realize your objective as a trader, investor, however you define yourself and conceive of yourself, what this message is saying, in order to do so, to consistently realize and win your objectives, it is necessary to accept losses. That's exactly the opposite of pretty much 80 to 90% of what we are attempting to do in all other aspects and features and components and compartments of our daily life. Accept losses, we're trying by our very nature, from the time we come in to the time we check out, to do the opposite. We're trying, if anything, in 80% of our daily activity, we're in loss mode. We're in loss avoidance mode primarily. 80%, we are attempting to remove ourselves as far away from as possible from any semblance of loss. So automatically there is this giant disconnect or spread of distance. We've got to make this jump from one mode of mindset and corresponding activity to the polar opposite when we put on our trading cap in the morning or in the evening or whenever you're doing this. That's a problem. Obviously, inertia has its way most of the time. We've got to automatically make what might seem to be kind of a blatant decision just to arbitrarily stop behaving in one way and adapt and immerse ourselves in a mindset that's polar opposite. We've got to get comfortable with the concept of living and being okay with losses. What a concept. But to do this business correctly, you've got to do that, even to the point of seeing them as no more than the cost of doing business. The old trade, when I first started, again, 30 plus years ago, there was a cliche that traders I would be around and I just would pick up and hear things, and it's ensconced in the industry. Learn to love your losses. What a concept. It's counter to everything else in the world external to the business of speculation. But we are in a very, very, very specialized endeavor or activity. So as such, it does on that level, when we put it in that context, make sense that to the extent we are very rarefied air here, we're in a very different business from most other vehicles and most other modalities that generate streams of income. As such, it does, in that sense, it makes sense that we're probably going to need to do things very atypical relative to the way most other things in our day-to-day life should be conducted. Studies show people dislike losses more than they like gains. Yeah. This leads to get-evenitis, a condition where traders hold on to losing positions too long as they hope for them to rebound so they can exit with a scratch. That's in fear. Wow, what a concept. Ace Greenberg's famous quote, "The definition of a good trader is a guy who takes losses." That's right up. That's basically the same sentiment of the old cliche, learn to love your losses. Yes. The only thing I would add to that famous quote is, as long as those losses, the magnitude of the losses, each one is proportionally small relative to the resource level of equity you are working with. So assuming that's embedded in that concept, certainly, this is critical. Losses are a good thing. So it immediately cuts against the grain of what common sense. But this is not a common business, so we need to do things uncommonly in this enterprise. Clearly, very important. Confirmation bias. Once we have formed an opinion of a situation, we react differently to confirming and contradictory evidence. Specifically, you emphasize confirming evidence and downplay contradictory evidence. This is human nature. Human nature. This is psychology 101. And we bring all of the problems, the baggage of our human psychology to the table. We bring very little to the discipline of investing and trading that's good. The positive, enlightening attributes of our internal state, they don't often, we have to work at carrying them and enabling them to improve our performance. It doesn't take much for the negative attributes of our internal emotional behavioral features to negatively and harmfully, in a harmful way, hurt our trading. They did an experiment, and this really has to do with our ego, and it has to do with our sense of fear that shapes and impacts and directs our internal state and our views of what we think, of everything that we observe. Okay, they did this experiment in 2004. 30 men, including in a study, 50-50, conservatives, liberals, Democrats, Republicans. During an MRI scan, subjects were asked to assess contradictory statements by George Bush, the Republican, John Kerry, the Democrat. The brain scan showed that the part of the brain associated with reasoning, the dorsolateral prefrontal cortex, was not involved when assessing the statements. Okay, the most active regions of the brain were those involved in processing emotions, conflict resolution, and making judgments about moral accountability. This means that after a certain point, we are not gaining anything from new evidence at all. Well, yeah, think about it. I'm sure that was true. Most of us, I'm generalizing, but I have found just casual, this is a more probably a controlled study to illustrate what I've observed for my entire life. People, because of our egos as human beings, we like to be correct, because with being correct comes a modicum of respect from the world external to our personal. If you and I, and any conscious entity considers, our viewpoint, our thought stream has to begin with an assumption that we are central and everything revolves around us. And as such, we have an ego. There's the center point, and then we interpret the world around us. And to some extent, it's important for ensuring more greatly the sustenance and durability of this consciousness that we reinforce this centerpiece, this ego. And to that extent, we need confirmation and affirmation of our view. So the sooner we arrive at a view, we may accumulate a certain amount of information, we tend to attach to it. We buy into it because if we've previously been rewarded and reinforced and reaffirmed and supported, that tends to, that we want more of that, and we carry this into the business. The problem with it, okay, so that in many respects, it has served as a survival mechanism for a conscious entity, a human being, let's say. However, in a pure information, a financial market knows nothing about that. It's its own entity. It is not picking up or is not able to clearly perceive anything in the world external to it. It is in an isolated vacuum from a standpoint of making the picture or painting the picture here. And it flows forward through time. It's a mechanism that we perceive to illustrate different levels or steps of energy, i.e. price levels, in a very abstract way of thinking of it. And as such, to the extent we form an opinion based on a finite amount of information, at some point we buy into that opinion or attach to that opinion so strongly that there is no new information, even if we were to be purely objective, that can alter that view. And that's very dangerous. That's the point of this slide. It's as if, by analogy, let me make a very technical example. One of the features, and the designers, Wells Wilder, Dr. George Lane, who developed the stochastic, Wells Wilder developed a string of indicators over the years. When some of the standard oscillator sets that you may be familiar with are set on a scale of 0 to 100. Well, one of the questions that I thought of, and I don't know, it's not profound, but it's an important question to consider. What happens if you have such an extreme, more or less the behavior of an oscillator, be it whatever it is correlated or is more or less up to a point linearly related to the price action. It's tracking the underlying financial system, the market. Whether you're looking at any of the standard oscillators, to some extent, the input to the oscillator behavior is the market motion. Some component or components or permutation or manipulation of the data from the market ultimately is what goes into creating the motion of the indicator, be it an RSI, any of the standard fare. Okay. Well, if you're plotting that motion of your indicator for the purpose of trying to figure out something about the market by virtue of the interplay, the interaction between the two systems, the market on the one hand, the indicator on the other, if this indicator motion is plotted on a finite scale, say 0 to 100, which many of them are, if you have such an extreme price action, a multi-sigma event where the oscillator moves to an extreme, say 0 or 100, at that point, it's no longer linearly related. Any activity in the market, once the activity has reached such an extreme threshold, the corresponding motion on the oscillator that's tracking that underlying market is no longer related, or in a way that it is related, but in a way that is undiscernible to you and me, the observer. This is why Gerald Appel developed an oscillator, the MACD, that's not set on a finite scale, so that it will more perfectly maintain a linear relationship. I state that just has nothing to do with this, other than it illustrates this confirmation bias. The same thing goes on internally in our thought process. At some point, you and I, what this slide is saying is we accumulate a set of information which, beyond a certain threshold, you could provide additional evidence that would alter our view, and it doesn't matter. Our view remains constant. We all have a finite amount of capacity beyond which it doesn't matter, and that is dangerous, is the point of this slide. So we've got to be very careful against that. That's another confirmation bias. It's because there is comfort in, and we feel good when we get congratulatory feedback. And to the extent we are vacillating, there's even, the world has in political arena, oh, this politician or this player on the political draw stage vacillates or is flip-flopping. So we don't want to be perceived to be adjusting. Well, in the business of investing, we do. It's kind of like, I remember a famous, I think it was a British Prime Minister or Secretary of State or something years ago, said, I don't know about you, when information changes, I change my view. If things stay the same, you more or less go on and maintain your view. But if the situation adjusts, I correspondingly need to the extent it does, need to adjust with it. Otherwise, watch out. That is especially critical in this business. All right. Learn to love the losses. They teach you how to avoid mistakes and change unless you repeat them. Yes. There goes the open mind. Mentally, yes. Confirmation, yes. Okay, thank you, Seth. This means that after a certain point, we're not gaining anything from new evidence at all. So it's a waste of new information. It's not beneficial. There's a disproportionality between the amount or the presentation of new info and our capacity to profit or benefit. It's as if it were not present. That is an intrinsic problem to this business insofar as the decision making and the actions we take. So we've got to make a special effort to ward off this confirmation bias issue. All right. Hindsight bias. Once an event has occurred, we tend to think that the event was predictable. A single realized, this is probably a function of a limitation of our cerebral capacity. You know, we're the organic architecture of a human. And this is where, going back, Chet, to your point, possibly many others out there listening, where the gross arithmetic and mathematical capacity of an external intelligence, such as a silicon-based system, i.e. computer technology and all things like this, and algorithmic ideas and software, can clearly, we've known this for, if not 100 years, at least half a century, outperform the pure raw data crunching of an organically based cerebral unit, where a silicon-based, i.e. computer technology and algorithmic ideas and entities as markets or in anything, not just in modeling financial systems, where they really are way at a deficit still is in the fuzzy reasoning and the what is it, the Turing test is and recognizing the nuances. We are infinitely, I don't know, we're up in the trillions of connections in our brain in terms of neuronal componentry, and that the density of complexity of an organic based system, i.e. of a human consciousness, is way in advance in terms of certain types of decisions. But in terms of raw computing, we're already, we clearly know that the silicon-based neuronal or structure is is vastly superior. So, why not meld? Yeah, I'm all for melding and getting the best of both and using a complementarity. Allow computer technology and the raw computing power to assist our what is it? I guess I would say fuzzy computational capacity, and there's a synergy there potentially. Hindsight bias. Once an event has occurred, we tend to think that the event was predictable. A single realized outcome is far easier for us to grasp than the multitude of possible outcomes. That did not occur. This leads us to overestimate the accuracy of our predictions as we retroactively fit them to data. This also goes by the name of "I knew it all along" effect. An obvious danger of this phenomenon is that very often leads to trading too big. All right. Trade size. The problem of trading too big, if it is a problem, is that it could potentially serve to lessen or decrease that sample period and correspondingly the number of flips or sample size. More or less, there's a direct, the longer the period of time for which you can extend your career, your trading business, the more samples you can do potentially in a more or less, it's not a perfectly direct relationship. And why is that important? Remember what I said at the outset. Any and everything we can do that will have the effect or impact of extending our sample size, which in turn, or sample period, which in turn it has the potential at least to increase our sample size, will serve to more greatly increase our odds for success. Because the more times you do this, the more closely you approach whatever the performance ratio is of whatever model or models or ideas you're using. So that's what's critical. So this is just a function of a limitation of our capacity to consider. The way around this is the problem. The solution is we've got to, in a more or less a parallel way, once we've considered the probability of manifestation of a particular set of events occurring, we've got to set that aside and go back to the drawing board and reconsider an altogether alternate idea. If we can't do it in a serial sense because of a limitation of our brain power crunching capacity, we must do it we got to do it in parallel. That's to the best we can. Or you've got to develop an algorithm that can do that. But this is the problem. That's the point I want to make. We may not have a solution. Often the questions and the problems are as important, if not more important, than a solution. At least there's a solution out there waiting, or at least we can work toward it. Again, biggest problem of all is not knowing what we don't know, in a broad sense, to illustrate this. Okay. Here's critical point, making the jump from what we see on the left side of this page to the right. Traders you know, there's a certain fraction of traders when we all enter into this business at the point at which we do, and then we begin our trek down our yellow brick road, or our pathway, our curve of learning. We make our ascent, however quick or however slow. You begin your ascent on your particular curve of learning, and and ultimately you adapt a type of analysis to that enable, hopefully the point of which is to generate and lead you to enable you to see when they occur value areas in a market for the purpose of exploiting. So there are two major camps: the fundamental, the technical. There's an internal, there's a third that I didn't explicitly state or show on the screen. You can call it quantitative. You can call it whatever you want: fundamental, quantitative, technical. These are all words to indicate forms of modeling. Doesn't matter. It's all modeling what? Information. And these are just varied schools or approaches or procedures or set protocols that tend to adhere to certain underlying governing principles. There's the fundamental approach, there's the technical, there's the quantitative, there's the approach that counts the number of black crows on your telephone line outside your bedroom window. If it works, it's all for the point of pointing out to you, hopefully more consistently than not, where there lies a discrepancy in the system we are ultimately attempting to exploit for profit. That's what we call analysis, and that's what most traders spend most of their time doing. That's fine. One of the problems is you could have the best analysis, and in the world today, 2015, about to be 2016, most professional at this business realize that the best of all worlds is where we have an amalgam, an integration of whether it's fundamental, technical, quantitative, you name it, whatever you call it. My area of research is cyclical analysis. I don't know what to call it because, strictly speaking, it's not purely fundamental. It doesn't go by, I don't look at supply and demand figures. I don't look at cycle analysis, doesn't look at the balance sheet of a stock if I'm an equities trader on the one hand. It doesn't look at internal affairs at a company, whether or not a stock is a takeover target. It doesn't look at earnings reports. It doesn't look at decisions, let's say by a drug company, whether they have a new drug under development that's pending approval by the FDA. Cycle analysis doesn't consider or care about any of that on the one hand, and as such it's not strictly speaking fundamental. It's not in the purview of fundamental, what a fundamentalist would think is normally what their bread and butter and what they do. On the one hand. On the other hand, it's not strictly technical. The technical approach, the centerpiece and the foundational theoretical idea or component of technical is that all information in the universe is implicitly discounted by the price. Price as a function of time. And so if I learn to interpret the behavior of price and the peculiarities and attributes and features peculiar to price action, I'm able to, at least in an implicit sense, understand the current state of the system, the market. And to the extent I understand its current state with ever increasing degrees of precision, I'm better able to trust in my extrapolation or projection of that state into the future. That's the technical thesis, or the foundation upon which the technical school rests. So cyclical analysis is cycles. It's looking at time. So it's a quasi, it's a gray area. I don't care. I'm interested from the practical standpoint of speculation in realizing return and maximizing return. So before I go make the important point, stock market is date valid for upside, downside. Okay, I got a bunch of things here. So before I do, let me just make the point on this slide. Okay, and then I'll come back to address the couple of points here. Learn to love the loss of the, yes, they humble you unless you repeat the same loss behavior repeatedly. Yeah, however, but eventually at some point you're gonna, and if you're continuing to, that's a very valid point. Here's a thought on that, just quickly. Yeah, learn to avoid the mistakes. Pay attention to the mistakes, however long it takes you to for every action, there's an equal and opposite reaction. So when you as an individual trader continue to make the same mistake over and over and over again, at some point, the recognition of the mistake is going to, you're going to take a, it's going to, maybe it doesn't immediately occur. Maybe the impact or the reaction will be more a slower, there's a delay with which it takes the reaction to manifest. Okay, in that period of time, cease and desist all activities so that you're not losing your resource, your money, while you're learning and generating the corresponding reaction, the response, the compensatory palliative measure to fix the mistake. In the meantime, go to the sidelines. Hold off on your trading, possibly, is just the common sense thing to do. I'm not suggesting common sense is always the best thing, but that would probably, just in a practical standpoint, help. Okay. There goes open mind, mentality. Yeah. Okay. Let me just make the point of this statement, and I'll come back to the points that have been made here. This is central. Okay, on the left side of this page, that's what many of us, many of you in the business. There are about 1 million professional traders in the world, and there are many, many more that apply this business and utilize and engage in this day to day, week to week, month to month, year in and year out as an avocation. However many traders in the world and investors and speculators there are, I'm sure there's a relatively large fraction or percentage that have become somewhat proficient on the left side of what's depicted on this page, doing the analysis. The problem, why is it if you were to do a study of the number of traders that have become proficient in what the left side, the analysis part, what's on the left side of the screen, and then compared it to the percentage of traders of all the total traders in the world that have ultimately have the commensurate degree of proficiency and competency on what's shown on the right side, the mental analysis, I would tell you it is an astounding it's a big jump, and that's why so few traders are successful. Whatever outcome this analysis, the 2 red arrows are pointing to, those 2 red arrows, the word analysis, I should have said results. I should have said analysis and then in parentheses or right above it, results, and put a big exclamation, because it's the information that you get, which is telling you the results of your analysis, whatever type it is. Okay, there is a very large percentage, I'm sure, of traders that have become very adept at generating relevant results. That's not the problem, unless it is. If it is, that's a separate issue. That's not what I'm talking about today. That's what we teach, among other things. That's what people spend most of their time studying, learning, reading, applying themselves to master. If that were all that is prerequisite, but as I always say, woefully insufficient to more greatly guarantee one's success. You the trader, that is you are now, assuming you've done the left side of this page, you are a proficient, you gain your certificate you graduate in analysis, but you are not a trader, or at least not a successful one necessarily, unless you happen to be an outlier of quirk of circumstance. And that can happen. That's a fascinating feature of this business. Yeah, by virtue of being in the right place at the right time, one can make a fortune. I love that. That concept never ceases to fascinate me. But as a rule, the gap here, that you somehow, a sales job, you have to sell this result to this mental analysis. That's to this inside the internal state over here, you the trader. Or if it's a automated, if it's a server somewhere, whatever is over here on the left has to make this journey to the right. You have to trek from here and transport this information and make it real to this entity on the right. Otherwise, let's look at the paragraph below. Think about the number of times you looked at a price chart and said to yourself, it looks like the market is going to go one way or another, and what you thought was going to happen actually happened. However, you did nothing except watch the market move while you anguished over all the money you could have made. Yeah, It's like I always tell people that I talk to, and I think about it. I'll never forget. It's probably the second job or third job I had when I was in my 20s. A broker. I worked at a company, ICS, 110 Wall Street, New York City, and one of the guys in the office, a broker, I was working as a broker at the time, used to constantly, whenever he was in a trade that was making money, scream throughout the office, just so everyone would know he was doing well, you got to be in it to win it. Something, I can have the greatest analysis under the sun if I never sell it to my internal state, to the right side. If I don't carry it, if I don't buy into it, heart, soul, and anchor, whatever that phrase is, if I don't completely grasp it, and if I don't have a course, if I don't act in accordance, it'll be an idea that might have flourished but died, and will never, the world will never know. My account will never know. More importantly, I always tell people, to be successful in this business, you got to be brutally honest with yourself, if no one else. I could tell my friends that I made a fortune, or that I bought, I love the concept, I bought the low or I sold the high. Who cares? I want to know, I mean, unless you do, if that's your objective. My objective is to generate types of returns consistently that ultimately will enable me to have flows of capital flows, monetary flows, to an account that I can utilize to impact have a ramification in the real world, so my life is the better for it. If that's my personal, in a broad sense. If your objective is to buy the lows and sell the tops, and you're successful through your analysis, so be it. If your objective is to realize certain financial objectives, you've got to take however relevant this analysis result is and get it over here. Somehow a mechanism of transport must occur. And this is thus the importance for what we're talking about today. Many traders, a vast majority of traders, as a fraction or a percentage of traders, have become very proficient at the analysis and feel there's almost this implicit idea, to the extent that that's all I got to do. Everyone does that. That's par for the course. You've got to sell it to your internal state to the point where it's so crystal clear that it cannot do anything but act on it, so that you don't have the phenomena indicated at the bottom here occurring. Or you can at least decrease that from occurring. That's what's important. All right. How to make the jump. In order to make the jump, you must identify the characteristic that separates the consistent winners from everyone else. Here it is. Winners have attained a mindset, a unique set of attitudes that allows them to remain disciplined, focused, and above all, confident in spite of the adverse conditions. Therefore, they are no longer susceptible to the common fears and trading errors that plague others. All right. The obstacle, emotional pain and financial disaster are common among traders because trading is full of paradoxes and contradictions. That's what I indicated at the very first slide. It's due to the challenges of, we don't perfectly understand financial systems. I don't care if you're trading a soybean or a jelly bean or anything in between. I love to say it because I heard Larry Williams say that in a meeting one time that I was in. It doesn't matter if you're trading a stock or a bond, gold, pork bellies, day trader, if you're on a tick chart, or if you're any and all. Markets are not purely Newtonian, and therefore I am not aware of even a hypothetical, say, alien technology that is perfect. If I were, I would keep it to myself, and I would progressively be capturing the entirety of wealth of the entire world, and no one would ever know. If I decided later at some subsequent point in life, for ego purposes, maybe to publish this, I don't believe that even if such a hypothetical understanding exists in the world, I don't believe it's pervasive, because if it were, you would see, based on the characteristic feature of markets, peculiar to markets, that is the feedback, the intimate feedback. We are part of the systems that we're studying. Some traders to a larger extent by virtue of their size and capital capacity, other traders to much smaller. There's a continuum of degrees of connectedness, and this is why it's the infinite feedback, or the implicit feedback. Traders can move markets. Trading entities, maybe individual traders less likely, but hypothetically, any trader has the capacity in potential to adjust and impact a market by virtue of the actions they take. We are an implicit theoretical part of the system we are acting on and in. So we've got to take that into account. Because of this complexity, paradoxes arise. What's the definition of a paradox and contradiction? They're kind of in a similar ballpark in terms of understanding what those ideas or words mean. It means that there are contradictions. It's kind of, I should have presented the slide where, the next slide, I think I've done a presentation once where I said this, everything on the next slide is true. And then I shift to the next slide and it says the previous slide was false. And it creates this oscillation of understanding. From one idea, you go from one opposite, it sets up a vibration. There's a superposition. There are two things that are implicitly contradictory, but they are existing simultaneously. They coexist, but they are the opposite. And that's kind of what a paradox is. It's an implicit contradiction, but it can exist in spite of the intrinsic contradiction. And so we find this, a lot of the features and attributes peculiar to this process of trading, immediately you see flowing to the surface are these paradoxes. And as such, if it weren't so, and that's what creates the mechanical problems and challenges. And this is why it's critical we have an appropriate mentality to interface and enable us to deal with the activity that we're doing day to day, moment by moment. Contradiction. Unsuccessful traders are obsessed with market analysis. Unsuccessful traders are obsessed with market analysis. Yeah, because that gives them that's an anchor. Market analysis gives me some modicum of say, however good it is. It's not all that good relative to the previous slide. The previous slide was saying, oh, wait a minute, where is it? Paradoxes, contradictions, imperceptible complexity. I don't know if there's nothing I am aware of that can enable me to completely understand implicitly all of the contradictions, all of the behavioral features and attributes of a market in a general sense or a specific one. Okay, and as such, the only thing that I know that can at least attempt to come close is my market analysis of whatever type it is, fundamental, technical, quasi-technical, quasi-fundamental, quantitative, you name it, counting birds on a telephone line, hooked up to parallel quantum computers at MIT or Caltech or anything in between. Anything we do and put under the category of analysis, to some extent, there is this sense collectively and individually, if there is, that I am doing something that's going to get me closer to some type of certainty where I can cut through the paradoxes and the contradictions. And that's okay. If there may be, that might be true. But if you feel that that's the answer, and that alone is the answer, you then become the first two words of this first sentence, unsuccessful. If you feel that market analysis, unless you just happen to be one of the statistical outliers, yes, that can happen. But as a rule, statistically, if you're putting all of your hopes on market analysis, more than likely you will be an unsuccessful trader, or this statement just states it in different order. Unsuccessful traders have this obsession with market analysis, as absurd on the surface as that might seem. They crave the sense of certainty that analysis appears to give them. And why? Yeah, I would crave it too, because it gives me comfort. Note, let me repeat that. Security of analysis gives me I crave it because it gives me comfort. Okay, if your objective as an investor is comfort, then continue to do that. I am not saying I don't want to be comfortable, but what supersedes as an investor, when I have my trading hat on, my primary and sole objective is profitability. Nowhere have I didn't say anything about comfort and warm and fuzzy feeling. I am not against warm and fuzzy feeling and comfort, but when I am in trader mentality mode and compartment, I am comfort, togetherness, sense of security. None of that enters into the fray. It should not be a thought in your sequence of stream of thought. Profit objective. Whatever your objectives are that you align with being a trader has to be at the forefront. But we get it confused often. Traders are looking for comfort. Comfort has nothing to do with the immediacy of output of what this business is about. If you happen to be comfortable, if you happen to be uncomfortable, it's irrelevant. It's a moot point, irrelevant. When you are locked into this mechanism. Unsuccessful traders attempt to create certainty where it just doesn't exist. How absurd is that? Ironically, once the fact that certainty doesn't exist is accepted, an alternate certainty is derived. That is, the absolute certainty that certainty doesn't exist. If there's one certainty, that's it. What an idea. How absurd is it to attempt to avoid the unavoidable is what the next slide. I'm thinking ahead because I wrote it, or I put it in there. The answer, learn to think in probabilities. What does this mean? Trading is inherently risky. In other words, no trade is a guaranteed outcome. When your system that you've developed works 83% of the time, it doesn't tell me, it doesn't tell you, it might, but it doesn't. It could, but it doesn't, as a rule, tell you that you're going to make 83% on your money the very next time you do your thing and enter a position or establish a position in a market. It might be, that might coincidentally or not, very unlikely, it could happen, but very improbable, but it could, but that's not the relationship at hand here. When you've developed a method that works 83% of the time, that ratio of wins to losses is telling you that the more times you repeat the process of what it is you do, the more closely you approach that frequency of the number of wins versus the number of losses. The distribution of outcomes will more and more closely resemble that ratio, but it will more and more closely look at something like that the more times you increase, the larger your sample size. If you just do 2, you may or may not look anything like 83% or whatever the performance ratio or fraction is. This is why it brings us right back at full circle to that point. Any and everything we can do to more greatly lengthen and stretch out the sample period, thus the sample size. To the extent you do it, you have more samples, you increase the size of the distribution, the deeper you go into the distribution of coin tosses or entries into the market and then exits, full round turn transactions, the more closely you begin to see the pattern, what I call the attractor, emerge of your performance. Trading is inherently risky. In other words, no trade has a guaranteed outcome. Therefore, the possibility of losing money is always present. Naturally, someone might consider themselves to be a risk taker in this environment. That is a problem. If we, that's one way of thinking about it. The way we want to really think about it is what's here, the solution. The best traders not only take the risk, they have learned to accept and fully embrace that risk. To whatever degree a trader has not accepted the risk is the same degree to which he will or she will avoid the risk. And that's what I said, trying to avoid something that is, we know, think about it. You say on the one hand, or we conceive and understand there is a risk. So if it's, I'm either going to be caught up and receive and incur that risk, which the consequence of this business, there's a debit against my equity, or I'm not. Why spend any amount of energy, time, effort avoiding the risk? It's either going to happen or not. Let the model, let that analysis that you spent so much time acquiring, the skill set to generate a result, generate its specific profile, a distribution of outcomes, some of which will reflect the alignment of risk, and then the consequence, you've incurred a business expense, an expenditure. That's a loss. That's my Glenn speak for a loss. It's an expense, cost of doing business. It's a manifestation of the risk of the environment we're living in and working in. No problem. It's part of it's the world, it's the environment that we work in. Risk. The manifestation is there is a change, there's a decrease in the level of energy or money in our account. But that's part of the process. That's a consequence of the ashram or realm we work in, moment by moment, whenever we're doing what we do. On the one hand, alternatively, there will be outcomes in that sequence where we generate a return. The consequence is appreciation in our energy or money in our account. Trying to avoid something that is unavoidable will have catastrophic effects on your ability to trade successfully. Yeah, imagine what it does to our internal state. Remember what we said earlier, everything in our day-to-day, from the time we come in, little infants, to the time we age out and cut it off, and the end of show, the end. We spend most 80% in day-to-day activity. We are trying to avoid what we perceive and have learned, and what we believe based on our mental internal construct, our reference is bad or wrong or negative. But all of a sudden, this business says we've got to embrace that. We've got to, so yeah, that is an obvious, we have to, I don't know how to do it, but I know it's imperative you must begin to take steps. I don't know necessarily, I should say. I know how to begin to move in that direction. Clearly, that's the point. Otherwise, I wouldn't suggest that we would make this attempt if it weren't possible to begin incrementally to move towards, clearly. But that I clearly there's no, yeah, when you put it in this way, it's clear, you understand it's a major disconnect. But that's what we must do if we attempt to survive and realize a modicum of our success. Steps in probability thinking. Anything can happen. I tell people, whenever you establish a position in the market, recognize immediately, before you've done it, while you're there, as you're doing it, constantly, 24/7, anytime you enter you have a position in play, you must realize there is a spectrum, 360 degrees of possible outcomes, some of which are profitable, some of which would incur an expenditure, and of all on a continuum of magnitudes, from one extreme to another. You must know that, so that if and when you incur an expenditure, a loss, there's not a surprise, there's not chagrin. There may be, I understand, but we have to work towards the point where that's part of the process. You don't need to know what is going to happen next in order to make money. What a concept. Some people ask me when I'm teaching Elliott Wave, Glenn, but Elliott tells me everything I want to know up to the present, but it doesn't, how can it project the future? I don't know. Sometimes, I don't know, I do know, but I'll make the point I don't know, but who cares? I'm not interested in that. I'm interested in making money. If I know everything about the present, or if I know a little more than about the present than I would otherwise know if I hadn't studied and saw some structure that particular model elucidated, maybe that will, on the continuum of probabilities, enable me to make money. Maybe I didn't say anything about enabling me to understand and know the future. I said it maybe would enable me to make money. It would increase my odds of generating a financial return and increase that to a larger extent on the continuum of odds. What number two, item 2 on this slide does not say, it's not saying that comprehension of tomorrow's Wall Street Journal or the future will hurt you. I didn't say that. This concept is not saying that. But it's not saying also, what it's also not saying is that you have to know the future to make money. It's just saying you don't need to know what's the future to make money. But it's not saying if you know the future that will hurt you or lower your chances to making money. It's not saying knowing the future will increase you. There are people that could know the future and still lose money. So you get the point. There is a random distribution between wins and losses for any given set of variables that define an edge. An edge is nothing more than an indication of a higher probability of one thing happening over another. Every moment in a market is unique. Mark Douglas wrote that in some of his material. So these are steps in, we've got to really crystallize all of these ideas in order us to more comfortably constantly think in terms of a continuum of odds and probabilities. How to embrace risk, distinguish the micro from the macro. From the macro, a particular pattern may have a certain edge. So whether you're doing chart pattern analysis, whether you're doing wave analysis, whether you see any macro pattern that has an attendant correlation or correlate is always going, unless it's perfect, and again, I allow for the possibility of some alien idea or relationship of any type out there. I'm just not aware of it. And I also know after 34 years that if it is in fact out there and implemented, it's not pervasive, because you would see, due to the intimate relationship of participant and system, you would see a corresponding degradation of the system. And I don't see it. So if it's being used, if there is some perfect modality or model available, it's not pervasive. Otherwise, you would see a footprint, a shadow of its implementation in the system we're studying. I don't see any indication of that. So by default, I'm able to surmise and inductively conclude that it's not, if it is present, it's not pervasive. Okay, the macro, a particular pattern may have a certain correlation or attached edge, yes. But why is it that it's not perfect? Because of the micro. At any moment, underlying market structure is different. There could be an infinite number of ways internally, microstructure, that all lead to the same or the similar macro level or global type pattern. And if any slight adjustment in the microstructure of a system, let's say a financial market, should change, you can alter in a negative sense the outcome of a macro relationship of a global pattern. That's why, let's say, a simple chart pattern, a head and shoulders, double top, a flag, whatever, doesn't work all the time because of the the infinite array of possible micro ways by which that pattern can achieve. The slightest perturbation of that could alter, in a negative sense, have deleterious effects on the macro correlation. This is why no particular pattern works all the time. Cognizance of the above will keep you from discriminating edges. Yeah, very important. You can't pick and choose you can pick and choose to the extent you start becoming more and more select. This is one of the other advantages, Chet, and anyone else is asking about automating or coding or becoming a systems trader. One of the positive features of automating your program is it will diminish. There's no chance of signal selection. A human consciousness, you and I there may be a greater tendency than an automated system to select the signals that are generating and tendered from my models. Whereas if I automate the process, it's automatic, and it will not discriminate the edge. And so the moment I start tampering with the output of my models is the moment that I tend to bring the negative baggage of my internal state to the ballpark, and 9 times out of 10 that will adversely impact my model, the performance ratio of my models. The final answer, detachment. You must be completely detached from any and all financial outcomes. That's the solution to everything. Everything other than the mechanics of understanding a financial market, to the extent anything you can ever learn, any type of analysis, whatever it is, anything under the sun that will enable you to, hopefully with some consistency, observe, locate, lead you to edge, and know it when you see it. That's one part of this business. It's an important, critical, integral part, certainly. But it's woefully insufficient. The other thing you need is what you see on this page. Because I know a lot of great analysts who haven't made a dime. They'll make a fortune. Then I ran into a guy when I was 26 years old and said, Glenn, on any given day I can make $1 million. And I thought he was joking. No, he was a floor trader for Merrill Lynch, and yeah, you can. That was 30 years ago. You can do much. He was being probably low. He was lowballing. Okay. You can, but in order to keep money consistent, it's not what you make, as the cliche goes, it's what you keep. You got to be progressively having an equity curve that is going to mirror and reflect what it is you want. If you want appreciation of your equity, you got to have the answer. You got to be completely detached from any and all financial outcomes. I don't care how that sounds, or it is the truth. However challenging it is to achieve this more and more levels of detachment, that's the pathway you got. That's the answer to every problem that you will ever think of attendant to this business. However directly you might think or no, that's the final answer, detachment. Jim Sloman, who passed away maybe half a year or so ago, put it to me very in the rawest form. He said, nothing matters. He was talking about the concept of detachment in a more general sense. He was applying it to one's life. Trading and your investing activity is maybe a subset within one's broader realm of existence. And the nothing matters is the same thing. You know, the detachment is just the manifestation, as it would be germane to this business. Is lack of confidence holding you back versus a lack of edge checking your confidence? That gets back to one of the earlier slides I mentioned. All right. Once again, this is just a recapitulation of the very first slide that after the commercial at the beginning and a presentation. What's psychology? It's the scientific study of the human mind and its functions, especially those affecting behavior in a given context. So, new paradigm, the future, a new perspective of trading psychology. Measurement versus direction. Most of us are very adept at keeping track and making notes and note-taking. We're taught from preschool or pre-whatever through wherever, one way or the other, formally, informally. So by versus, there's a different paradigm I project, or I'm going to posit for us coming up. And this is illustrated in this little interchange between a hypothetical student and a teacher. In a way, I suppose, this is the student, I suppose, but I use my voice as a ruler. That's the archetype of measurement. I want to measure something. The scientific paradigm really touts, the fact that we can measure something. Okay, big deal. I submit to you, let me be a little provocative here, that's highly overrated. We've been doing that since antiquity. Yeah, so I got a ruler. I got a device I can measure. Let's move on. We've seen that we can do that. Okay. For comparative purposes, but I use my voice as a ruler, measuring the words of my teachers with my intuition and or some related faculty. I don't originate the thought or idea, simply evaluate it. Okay, we've really over thousands of years now really done a lot with our ability to measure stuff. Okay, here's a response. And why do you do this? Why do you assign yourself the diminished role of measuring and analyzing instead of creating an invention? I throw this out there for your consideration. Here's an example of measurement paradigm. And I believe I wrote this, I don't know, somebody asked me to write up something, my views of an overview of years ago. But it applies to what I'm talking about here. A basic premise of technical analysis is that all information one needs is contained in the price. I said that earlier. By extension, each and every day, and in fact, each and every moment, a market's price is composed of a time and price component. In other words, this space-time, or more precisely, I should say, price-time continuum of energy is what we're observing when we view a price chart. That's what I believe. Not everyone believes that, but that's what I believe. If and when this energy, which represents the market, moves by a certain specific amount of price time, it reaches an equilibrium point of balance. By definition, a balance point is so sensitive, it marks or corresponds to a point of change, or a turning point. You and I, traders, we call them tops and bottoms. Okay. Essentially, tops and bottoms are points of resonance that allow energy to come in and overflow the system so that it changes. Okay, that's fine. That's true insofar as it goes. I submit to you, it doesn't go far enough. It doesn't go all that far the way I view the world in my activity in trading, but it's true nonetheless on a certain level. Okay, so let's think about what that slide says. Here's the future, or my casting or recasting of it. Okay, the student paradigm of measurement in contrast or juxtaposed to invention. Here's an active psychological paradigm. So I am no longer a passive investor, but I am an active progenitor or propagator. Same ideas, but a recasting, a reformulation of what the previous slide said, taking into an account this new archetype. A basic premise of psychological and or behavioral speculation. So I am no longer thinking in terms of ensuring that my internal state doesn't adversely mess up my models, the analysis stuff, but it is rather, I want to make sure it's meshes well, and it's an appropriate receiver of the analysis results, so that I can react to it and place an order. I can push my keyboard, send an order to the exchange that hopefully has a good, profitable outcome. That's all passive, even though there's some component that's relatively active. Let's completely contrast that. A basic premise of psychological and or behavioral speculation is that all market motion, past, present, future, originates and is informed by energy, which emanates from the speculator. By extension, in other words, I create the stuff you create the stuff you see on your screen. If you don't, folks, if you can't get with this is the future, and it's my view, so I'm not trying to solicit your agreement, I'm just telling you this is my paradigm. By extension, each and every day, and in fact each and every moment, a market's price is composed of a time and price component. Yeah, that's basically the same as the old paradigm, but it's not telling you how and why that's so. It's just stating a fact. In other words, the space-time, or more precisely price-time continuum of energy is what, here's the new thing, is what you and we collectively are creating when we interact with a market and its chart. That's a 180-degree shift right there. In other words, this phenomenon is what you and I are creating. So when we interact with a market, how do you interact and its chart? The chart is just a means of registering the system we are attempting to interact with and get on board or get into or become a part of and align ourselves. We're trying to dock. Essentially, this is a docking issue, like the spacecraft docking with the space station, by analogy. In the old paradigm is, I want to make sure I am the passive receiver. I am the plug, or the outlet, or whatever it is. I'm the receiver to which the plug will interject. Versus this is, we are creating the system by virtue of our mentality. And if and when this energy, which represents the market, is moved or manipulated in a specific manner through certain amounts of price time, it reaches an equilibrium point of balance. Because by definition a balance point is so sensitive, it corresponds to or marks a point of change. In other words, the market turns. Okay, that last sentence is the same. That's a little bit of the old still carries over to the new. But the first sentence, if and when this energy, which is the market, that's still old, but here's the new. Inside the mid part of that sentence, is moved or manipulated. Not when it's measured or assessed or understood. That's the passive. That's the old slide. That's the preceding slide. The new the recasting is when we, by virtue of our mentality, adjust and manipulate through certain amounts of space-time or price-time. That creates the outcome. When the collective energy reaching the market achieves a sufficient degree of resonance, sufficient to create an energy overflow, the market changes course. So two different viewpoints of the same underlying phenomenon, mental manipulation. The universe responds to your directions or directives, not your questions, hopes, and prayers. If you choose to define your future by telling the universe what you desire to experience and appreciate, you hold these thoughts, and you hold these thoughts in your mind with fierce persistence. The universe, by its own design, will respond accordingly. If, on the other hand, you ask questions and pray for answers, the universe will respond with a deafening silence because you have not given it direction. When I first presented this and read that back in the spring, last spring, I got negative reaction and I started to take this out. I am not trying to put out there a viewpoint, philosophical, religious, or anything. I'm merely stating a natural principle. So the intent of this slide is not in any way to offend any particular proscribed viewpoint, philosophy, metaphysical, religious, etc. It is merely to indicate a concept of natural principle. You don't, and I'm also neither. I'm not even. I'll even be more general and euphemistic here. I'm not even suggesting that one has to believe this. It is just an idea. I happen to agree with it. I'm not even trying to compel one to align or believe in it. It's just a thought, a viewpoint that I think is relevant to the previous slide. That's all. Okay. Let me now that I have a few slides to illustrate the trades that we have coming up and that we're in that are relevant, so I can jump from the mental to the intangible to the tangible. Okay. So let me just see where we are. Yeah. And I think there's a few comments or questions. There goes open mind mentality. Yes, agree. Not to open new information would be the locking of the old information. Yes, fixed opinions. The ability, someone saying, i.e., thus the meaning that thus the inability to trade connected to the present moment. In the last webinar, I mentioned November 23 as a turning point for the stock market. Is the date valid? Yes, Sheth, and that's one of the trades that because it's coming up Monday, 2 days from today. Today is the 21st. The 23rd is a critical date for equities in the United States. It happens to be this Monday. Commensurate or probably, in my estimation, I'll now respond. The subsequent slides coming up in a minute are going to speak in more detail on this. I have on the 26th a time projected date, a theoretical projected point I've generated for the bond market. And then at the time I did it, I don't know if I mentioned this in a previous presentation, I wasn't thinking. I looked on the calendar at some point and realized the 26th is this Thursday is Thanksgiving Day. Whenever you generate or project through whatever type of analysis a time point that happens to come in on a day when the market's not trading, such as a weekend and or a holiday like what's coming up this coming week, it complicates stuff. Life gets complicated. This is a particular case of complication. Rarely are things straightforward and crystal clear, especially when we're talking about the analysis of a which is merely a mechanism by which we're hoping to apply so as to create some understanding and clarification of an intrinsically complicated system. Dynamic, mixed with periods of linear motion along with nonlinear. There's cascading types of behavior. There's evidence of self-similarity, the fractal structure. There's a whole componentry of complexity. I'm not quite certain even at this very moment whether I should consider the 23rd, this Monday, and the 26th as a single data point, but a wider one, or are they two separate data points? Just I'm trying to give you a little insight. But yes, the quick answer, and I'm going to speak to the trade situation here. Yes, it is still, when I generated a date, it is based on the tools that I use. It's not, yeah, from a time standpoint. Price can change typically, but time is more permanent. There's a permanency to a theoretical time point, not necessarily similar in the same degree in price. Price is more it can vary. Okay. Yes, and I'll talk about the trade that I see there. But yes, the quick answer is that is still as valid as it was at any point I previously mentioned that. And then, okay, so you're talking, is the date valid for the upside, downside? That's what I'm going to talk about. I am, just let me say now, and I'll come to the charts to graphically illustrate my comments. I'm embracing it now, curiously, because a few weeks ago I would have said it would be looking to go long, but given the price action of the last week and a half, I'm probably looking, I have a bias at this very moment to go short, but we will examine the subsequent slides in a second. So I'll talk in more detail on that. But that's the type of question, good question, Chef. It sounds like it is it's human nature to search for the Holy Grail. Yeah, and there's, by the way, I am constantly doing that. I am not implying that one shouldn't, we have for the last 200 years, traders, researchers, academics, practitioners, both, we are constantly pushing the efficient frontier in improving our analytical methods of all types, fundamental, quantitative, technical, whatever word you say, integration of all of these things, computer and artificial intelligence, anything. This is one activity, speculation, market operations, investing, whatever you want to call it, where the cliche of thinking outside of the box is truly applicable. Anything and everything that will, I am Machiavellian to the point where the means, or the ends rather, justifies my means. If that's my objective, if my objective has always been maximal financial return in all types of ways of manifestations of that. Anything and everything I can, a professor, I always tell people one of the greatest insights I ever had in my ability in this business was I had a professor in college that said, when you're trying to solve something, a problem that seems to be at any given point in your attempts intractable, and you think you've considered all of the things that are possible, he said something that to this day, I venture to say it will never cease to astound me. He said, consider the impossible. I don't even know if that concept if that's real, if that's even a real concept, but it takes me to, it has enabled me to see levels of success that I probably would not have otherwise, had I not even been aware of such an audacious concept. Anyway, yeah, so I'm not saying don't search for the Holy Grail. I'm saying search for it. You kind of have to have, but because if you find it, remember what I said earlier, assuming you find that quote unquote Holy Grail, keep it to yourself and then do what you will with it. If you decide to release it, that so be it. But if you understand the objective, by definition, the construct of this business is maximum return. If you choose to accept or want some recognition for the unlocking, the location, the elucidation, the construction, whatever, of the quote-unquote Holy Grail, that's up to you. But once you have that, why would you need you don't need anything that we've discussed today, unless you do, unless you mess up the Holy Grail by virtue of a human interaction. If you have an inappropriate interference by virtue of something that is from your internal consciousness, even messes up the Holy Grail, then you would need everything to adjust your internal state so as not to interfere with that quote-unquote Holy Grail. But certainly nothing I've said today is contradictory. They are complementary to the effort. What I was about to say is, progressively, on the analytical front, for the last 50 years in particular, market researchers, academics, traders in the real world and in the academic community have made tremendous strides, primarily in one area, very specific, in reducing the degree of what we call the measurement problem. Measuring, or the accuracy with which we're able to make measurements. And the accuracy reduces the magnitude of error. Let me repeat that. By increasing accuracy, we make smaller the size of the error in a particular measurement. This is what physicists refer to as it's a problem in quantum mechanics. It's called the measurement problem. And it arises directly because when you attempt to register or obtain information about a system, and if the system is complicated, it's even more, there are complications that come. Whether it's complicated or relatively uncomplicated, anytime, any system, you attempt to learn something about it, there must, by definition, be an interaction. The only way you, me, or any conscious entity, or even, I would dare say, unconscious entity in this universe or any other, is able to comprehend something about something other than itself is by virtue of an interaction. The interaction disturbs the thing you're attempting to learn something about. It's the disturbance that creates the a degree of ignorance in your understanding of the thing you're studying. We have in the last, well, really 100 years, since the early 1900s, people like L. Jensen, Gann, George Baer in the 1940s, Robert Krauss, a lot of market researchers and people at university level, people who study financial market motion, in particular, economists who study this in particular. At the micro level, we have made tremendous strides in reducing the degree of measurement error. But that's not, okay, so what we've done is we've kind of like hacked the system. We haven't really addressed the real problem. We have addressed a peripheral problem, which is, the peripheral problem is we have the size of the error, the measurement, the error that arises due to inappropriate measurement devices. We have made our measurement processes and devices and mechanisms that much finer. And to some extent, this has improved the results of our analysis because by reducing the error, we're able to assess more finely, with greater degree of accuracy, the current state of a system, the market. If I know that the market is such and such a price at such and such a time, by virtue of projecting it out on an assumption of inertia, of linearity, Newtonian idea, we're to some extent able to improve the accuracy of our forecast. If I know what the weather is today, and in very specific terms, degree of pressure, barometric pressure, wind speed, degree of precipitation or humidity, I am then able to take the present and on that assumption of Newtonian linearity, assuming there are very little perturbations in that current system, track it and assume it's going to move on a straight line, and therefore generate a forecast for tomorrow or next week. That is okay, but that's not really the central problem in forecasting any system that has nonlinear componentry. If it were perfectly linear, that forecast would work out perfectly 100% of the time. Why doesn't it? Similar to weather, the meteorologists who attempt forecast of weather systems, the further out into the future you attempt, the less you begin to see a trailing off in the accuracy, and that's because there are however small your size of error is, that's not the problem. It is a problem, but it's not the central problem to forecasting any type of system that's dynamic, that's not a static object, but that is moving, is in flux, and has a component that's at times is nonlinear. And it's the very same problem that plagues meteorology forecasting and the models that meteorologists use to attempt to improve their forecast, which is what is intrinsic to this business. At a systems level, market structure and behavior is very, very similar to weather fronts and weather patterns and systems. And this is why in the last 30, 40 years in particular, market academics and market researchers have begun to apply some of the very same tools that the field of meteorology has applied to enable us to improve the accuracy of our weather forecasting, and that's nonlinear theory. The best that nonlinear theory can do, though, is identify realms of finite boundary. That's the best it can do, what's popularly known as chaos. The problem with that is within a finite realm or finite boundary lie infinite solutions. The reason it's what commonly is known as the butterfly effect. However small your error is, and that's where we've made the big strides in the last 50 to 60 years or so, the error is not constant, and it over time it approaches exponential. It increases, and that's the fundamental problem of forecasting any system that's dynamic and it has a component that's not purely linear, or is rather non-linear. That's why we have problems there's no mystery. That's the underlying reason. We have kind of hacked the problem by approaching a peripheral issue, not the central issue, because to everything I know, we don't know how to improve and control the error expansion of a system that's so complicated, because it's like a taffy. You can't go back perfectly. The system has an arrow of time, and you can't reverse it and go back due to the complexity. Let's see if there are what other questions before I go to the market trades here. Accept that it can't be done, so the trading plan must protect me from myself. Yes. AKO, always lock in partial profits, but always let a percentage run with the trust. Those, yes, whoever's saying this, those are all vestiges of good capital allocation, i.e. money management strategies, which are integral and critical and necessary because we don't have perfect, because we're dealing in probabilities or spectrums of odds. If we had the Holy Grail, if you had a perfect model, there would not be a need to think of this business in a framework of probabilities. There would not be a need to have protocols that say when the market is moved in a certain degree in your favor, you take a little bit of out, you scale out or trail a stop. We would not need any of these monetary and money management protocols. To the extent there are realms of uncertainty. I don't know the particular array or distribution of my profile, when my winning trades in the distribution of outcomes will turn up in my outcome, or will they occur prior or later, or what the particular mixture or admixture will look like. I don't know how the complexion of my return sequence will look like, whether it's going to be I'm going to get all my ace cards up front or my jokers come up front. And I got it, and as such, it's necessary and requisite that I have appropriate money management to more likely ensure I preserve the fuel, the money in my tank, so I can prolong that distribution as much as possible, so as to give an opportunity, as much of an opportunity as possible, for the winning trades to occur, so as to serve to offset the losing trades, so that I more greatly ensure the longevity of my career. Am I protecting myself and bias, or am I an unbiased receiver? Hard to do. Theory of karma suggests things will happen according to destiny. That I agree. Theory, I would say that the karmic proposition is on a level, it is aligned very, in a sense, karma is a manifestation of a similar idea of for every action there's a reaction, equal and opposite reaction, if you think about it. There, at least that's, I would say there is a similar, I think those ideas, if not exactly the same, are aligned. There's a very a close or strong nexus in terms of a karmic concept with that first law of motion idea, or one of the laws of the motion. To the destiny written, no matter if someone is super smart or super dumb, asking the universe your desire is nothing but cashing the destiny. Or, I agree. And it's a resonance by aligning what what the slide is saying is get into alignment with a reinforcer, and so you create this resonance. That's all. It's really an extension of that, of the concept. So yeah, the comment I'm in alignment with. Let's go to the trades, folks. I think that's so I can quickly wrap up. This is the trade we entered in. I entered in 2 weeks ago. 5 up, 3 down in orange juice. Typically OJ, I haven't traded in the orange juice market in about 7 or 8 years. OJ is notoriously illiquid. So as a rule, all things being equal, you typically don't want to be in illiquid markets. So it's not for this is not for everyone, but assuming you have a capitalization, a level of funds sufficient to shield you and compensate for the lower degree of liquidity, just as a safety measure. But more than that, even before you get to consider whether or not you would have the appropriate particulars that define your account that would be commensurate to do this trade, you want to, what's my rationale here? Here's the wave structure: 5 up, 3 down. I believe this is an hourly chart just to show a little more clarity of the wave pattern as I have depicted it, or as I observe it. Wave 1, 2, 3, 4, 5 up at the top. This is just an hourly chart I printed out a couple of days ago, or yeah, yesterday actually. This is yesterday's chart, but it's an hour by hour breakdown. What happens at the end of a fifth? We have, these are the 5 waves. This is an Elliott wave cycle. For those of you who understand, if you don't worry. It's just an illustration for those who do. The part of the rationale for why I'm expecting declining OJ prices at this juncture. I believe that this top, where we have number 5, marks the end of the bull phase, a set of 5, based on a particular model, Elliott wave principle. What follows subsequent to that is an ABC correction. So this would be maybe one wave here, then you have a little, it looks like a lightning bolt, A, B, C. It goes in 3 segments. And as such, that's one reason, one factor that I'm taking into account that would be a causative agent, as it were, and is causing me to expect declining prices in orange juice based on that. Rarely do I place a trade on a single factor. Someone's actually bringing up the liquidity issue, or ironically, OJ market is, yeah, that's what I'm saying. That we are, yeah, I am certainly it is very, OJ, coffee, lumber, pork bellies, platinum, palladium, there may be a few others, but they are historically very, very low interest, low liquidity. So I would only consider a market which on all intents and purposes is a little more treacherous terrain in a sense, given the idea that there is a degree of positives that would serve to overwhelm the typical and attendant and normal reasons I might be dissuaded or hesitate to trade in this market. The last time I traded in OJ, we did very well. I actually was a speaker. They brought me in to speak on it in New York. This was, again, many years, 8, 9 years ago. I can't remember. So I don't. It's not as if I trade in OJ all the time, but I see a salient opportunity, I believe, in aggregate, which will serve to overwhelm the confluence of typical factors that normally would discourage me from trading. And when I do, and by the way, folks, let me just I made a point to someone I was talking to in an instructional session yesterday. Yes, you got to be very careful with markets that are illiquid. You can get hurt, you can get burned, you can lose money very quickly, quicker than you might otherwise, even under optimal liquid scenarios. But we correctly and should appropriately highlight that. Yes. But also let's not forget, I'm not going to emphasize it as much, illiquidity can work to your advantage. You can make money quicker. Market can gap. What's liquidity? Liquidity, well, there are all sorts of definitions. It's a consequence and a function of volume and or open interest. But really, in a practical front, a practical working definition of liquidity is the probability that at any given price on a scale of prices, there will be a counterparty for whatever operation, whatever order you place at any given level on a price axis. That's a working, tangible definition of liquidity. Again, let me repeat. It is a measure of the probability for which at any given price on a price scale, a range of prices in a financial system, you will find an opposite side, a counterparty to take the opposite side of your trade. To the extent you have lower liquidity, it's less likely someone is there at that given level to consummate and create a transaction. As such, that's not good for you, if it is. But it might be if the market therefore moves in a discontinuous fashion to the next higher or lower level, depending on your position relative to the trend at motion or at play at that time. I'm not, yeah, I had to be I was so quick, appropriately so, and one should point out the inherent pitfalls of low liquidity or illiquid markets. Clearly, there is a present danger greater than average, clearly. But let's not also forget, it could potentially work to a trader's advantage by virtue of the acceleration or ramping up the velocity of trend. And that would work, obviously, if your position is in alignment with that trend. That's all. Okay. So I'm merely, just again to repeat, I believe that the confluence of factors that I feel are suggesting the market should come down far enough and quick enough and in a manner consistent with my the aggregate of things that I'm looking at to more than overwhelm the normal reservations I would have about trading in a very illiquid market. And in this case, that's the case. If a trader says you have very, and it's by trader case, if you have very small, don't trade options in this market. So this trade is not for every trader. If you don't have a certain threshold of level of equity that would more than compensate for the attendant problems, this may not be your trade. But on the other hand, just in case you have a level of equity sufficient and you're going to trade the underlying and you know the attendant pitfalls and we take measure, we have a safety net in place in a worst case scenario, then this may be a good opportunity. That's all. It's just, so I'm not suggesting this is for all traders. Certainly you have less than whatever, but that's case by case. Okay, but I wouldn't trade options in this because the options are going to even be less liquid than the underlying instrument. So this is the wave argument. I believe that we are entering in just recently the bear market phase. Okay, so this is an example on an hourly basis, a little more detail, granularity or detail of what I'm seeing here. This could be the A, this could be a B of a smaller scale, or we might still be moving down to A. Okay, but that's my wave explanation or reason as to why I'm expecting. Now, this is a commitment of OJ commitment of traders report. This is a weekly chart. No, this is a daily. I thought I'd printed out the week. I had the weekly in my own. I'm looking at further back. This is just the daily chart. Same chart as the previous. No, this is the previous was an hour. This is daily, so it's just showing it on a daily view. But what I want to see is what you want to see is these lines down here. Notice the red line. That's your commercial. They are at the most extreme that they've been in, going back more. Well, actually, this is going back till last summer. The lowest, the largest net short. That's the red line. Notice the progression from left to right. This red line has been, had a little blip up here, but notice they are currently at the lowest, the largest net short position that they've been in going back. In this chart only show, I should have printed out more time, but it's actually more than a year. But what's important is that they are at the extreme net short. And what makes this especially compelling, notice the blue line, if you can. It's almost the opposite. Now, it's not exactly, because the green line is more closely polar opposite. But what's very atypical and rare is that the small traders, the blue line, red line is the commercials, blue line is the small traders, right there. It's almost polar opposite. 85% of the time, the traders that this blue line is representing are wrong. And they're almost in a position reflecting what would be a polar opposite positioning to the commercials. This type of spatial arrangement graphically illustrated on the COT report between the commercials and the small specs happens less than 20% of the time. 80% of the time you get what the green line is showing along with, relative to, they are in perfect polarity to each other. The green are the large institutional hedge funds primarily and big traders. Less frequently, again, less than 20% of the time do I see almost a polar opposition, if you will, between the small specs and the commercials. When I see that's almost as if it's a catalyst or a trigger that would serve to expedite and accelerate the velocity with which I expect. The wave count is suggesting the directionality of the trend in this market to occur. So that has nothing to do with the wave count in and of itself. The fact that I got this very atypical, very infrequently observed phenomena or polarity almost, not perfect, polarity between the small and traders, specs, and the commercial activity is another indication that we are either at the top or nearly at the top. I believe that an argument could be made that this could be the A, this could be the B, in which cases this is the C, or the market may skip the entire bear market and just start or ABC component and start a new, just generic bear. This could be the 1, this could be the 2. We might be at the onset of a 3, which would make, in all likelihood, the decline that much more explosive. Even if it's not, under all circumstances and scenarios that the wave structure, as observed on the daily, hourly, weekly, monthly chart, indicates directionally the market should be declining. The fact that commensurate with that, I am seeing the largest net short position that we've been in for more than a year on the part of the commercials, and simultaneously an approximation of polarity of positioning by the small specs suggests the rapidity with which and the imminence with which we expect this move to commence. So that's my second argument for the orange juice trade. If anyone is interested, you would have on the details as to how one would approach it, because each situation is different. You should contact, you'd have to contact again, Peter Newman is the person, and maybe I could go over in detail. The people I work with and consult, I would go over the details with individually. Okay, but that's one idea. We've already gotten into it. I got in at a price lower. I'm short from basically 146, 147. We're at 148.40. Okay, so here's just the chart again. Current OJ printed out just to show where we are as of yesterday's close. I'm short kind of down here. I think we're getting ready. There's still time for those who are interested, and that's where we are as of yesterday's evening. This is the most recent quote. We're at 148.40. If I can see, I don't know if you can see that right here. This is the current close as of yesterday. Getting set up. This is a position trade that could last for weeks, if not months, given the proportionality, the amount of time since the bull market. There tends to be symmetrical proportionality, but if this is what I deem to be what I call the primary scale, a primary cycle, 1, 2, 3, 4, 5, ABC lasts for about 2.5 to 3 years almost. So that would give me some indication as to the time period. You can see how long I expect the amount of time. And as we get into it, I will begin to project more precisely specific time points as we see price action that is, if it's moving and hewing to my forecast. Okay. This is a price target for juice target price. Here's where we just immediate conservative estimate. If this is an ABC correction, just on the particular scale that the daily chart is evidencing, we're currently, again, this is the close yesterday, 148.40. If it turns out that this is just on a particular degree, this primary scale that I'm thinking, I'm going to be conservative. If this is the A, this is the B, this is a zigzag type correction, conservatively A and C, the move from this top, the current top, down to here will tend to be duplicated from B to C. If that were the case, that would bring you down to, we're at 148.40, that would bring you down to about 138. About a 10-cent drop. Every penny more move in this market is what is it? $150 per penny per position. Now let's be conservative. Let's say I have messed up some of this. My thinking and formulation and assessment is not quite what it should be. Let's be conservative. Let's say it just gets back down to point A, which is just eyeballing that about 143 maybe. We're still making 5 cents. Let's say it moves half, 50% of my theoretical target. That's still 5 cents of appreciation of or depreciation of price corresponding to 5 cents of equity appreciation per position. That's just, so that's an idea. This is a theoretical on the idea that this is an ABC correction. I'm theoretically projecting about a 10-cent decline from current prices. Okay. If, let's be a little more ambitious. Let's say I am incorrect and I'm being too conservative. I ought to be more ambitious. Let's just hypothetically suggest. If this is not an ABC, but rather if it's a 1, 2, and this would be a 3, the move from B to C would come down probably into here, around the lower 133 area, 132, 131 area. Why? Because it would then be about a 1.618, a Fibonacci ratio extension of A. So I'd measure the distance from this top to this bottom, take 1.618 times of it, get an answer, and subtract that from B. That's going to bring you down in here, just eyeball it. But I wanted to play it conservative, assuming it's just a normal run-of-the-mill ABC zigzag. A and C of a zigzag tend to be roughly equivalent. And that's going to project about a 10-cent decline from the current price at 148.40. That brings you down to the 138 area, between 138 and 139, let's say. 138.50 is my actual precise target, as indicated here on the scale, if you can see that. Okay. If you only got half of that, it's still a 5% or 5-cent drop. So that's what I'm projecting for this. Again, yes, not for every trader. If you have any questions, if you know what I'm referring to, yeah, this is a more riskier speculative play given the average lower liquidity present in this market. I simply believe in the total confluence of factors I'm taking into account, there's enough positive evidence to suggest a play here that more than offsets the attendant factors that would normally keep me out of a market or a position like this. All right. The E-mini trade. The yellow line, yes, to your point, Sheth, earlier, and anyone else who might have have me bring this or heard me mention this months ago or however long ago I've been mentioning this and aware of it, we have coming up this Monday. So what has the market been doing? This is the E-mini S&P. This is printed out as of yesterday's close at the evening, as after the market closed. We're trading, we closed yesterday at 2088.75 basis the December S&P. If I had talked to you 2 weeks ago, I thought the market was going to continue down and this would be a bottom. I've got all manner of cyclical, geometric, I've got about 5 or 6 different models that give me confidence that on or about November 23rd, some transition in the broader U.S. equity market will occur. Now, one type of transitioning obviously is an outright top or bottom, or a 180-degree shift of direction, a trend reversal. On that idea, I'd be looking currently, the play is, or the rationale is, ask yourself, what's the market doing as it approaches, as it lands on that time point? Well, it's going up, which is in contrast to my thought 2 weeks ago. We were coming down, and I was surmising that this would be a base of support, a springboard from which we would begin the so-called, Santa Claus rally into the end of the year. 50 years of every decennial period tend to be years of ascension. If you read and understand cyclical theory of people like Gann and W.D. Gann and George Bayer in particular, and Jensen and Robert Krauss, all realize that the 5th year of every decade for the last 200 years has overridingly statistically been years where equity markets are appreciating and end up in higher territory. The 6th year is not looking good. The 6th year of every decade, so 2016 coming up in a few weeks, I'm expecting is probably, all things being equal, without looking at just in a very macro way of thinking, I'm making a broad generalization here, is probably going to be the stock market will be a woeful time for equities in the United States, is my guesstimate at this juncture. I'm just making that I need to do further work on. But right now, I expect overall we're going to be moving higher into the end of the year. But given the most recent action off of this pivotal bottom right here, into where in relative proximal to where we're so proximal, we're essentially 1 day away, not if we discount the fact that the market's not trading on the weekend, on today. It actually is trading part of the day tomorrow. So essentially, you start the idea of how to exploit the information based on the behavior, the motion of the system as intricately as you can track it as it gets ever and ever closer and proximal to your point of data, of information, which in this case is a time point, the horizontal axis. And what is it doing? Well, right at this moment, it's rising as it runs into it. So that simple analysis suggests I should be more, develop a bias of trade directionality of short, because on the assumption that this yellow line corresponds with a point of change, by definition, what's changed? The opposite, most common type of change would be the immediate reaction, which is the opposite type of action. So that creates this bias to look to go short. So I then got to ask myself, well, how does that fare and play in with all the other pieces of information that I'm thinking about? Might we go down into a interim turning point? Also, how does it reconcile with the fact that there's going to be probably, no doubt, historically lower volumes because it's a holiday week of significance coming up? Got to take that into account. This is just a way. This is an hourly chart, the same chart, just an hourly chart of the E-mini S&P, the December contract. So here's what I'm going to do. To play it conservatively, unless you want to be a real gunslinger here, in which case if you're more aggressive, you just adapt your position and look to get out quickly in case if you don't get confirmation and follow through by the trend. If you're more conservative, what I would be doing in principle is, as the market continues to move up, here's the time point. This is an hourly chart. So we're going to see this begin to tick again by tomorrow evening. This will be moving ever closer to this important line here. This is representing the time point. As we ebb closer to it, I'll be watching clearly to see what is its angle of inclination at the point of arrival, on the touchdown in the docking mechanism. If it continues more or less over the period of time that the window of time to move higher, I'm going to be more and more strongly embracing the short side as an idea. And so as the way to filter that, in case you're wrong, is I could not see on the previous slide, critical zone. Look at more or less from this bottom, it's more or less going up. Each successive bar had a higher high. So it's more or less moving as a single wave. As such, I didn't see clearly obvious salient zones of support or bottoms or tops that could, or graphic representations of support. This is the hourly. That's why I went. This level right here is graphically showed, just drew it at the level of the horizontal line, and this higher level. So my idea typically is to place a sell stop, 2 zones of support behind, or underneath in this case, the market, so as to make it a little more, raise the bar as it were, require that the market show a little bit of evidence, show a little of its directional hand, if you will, that it is going to actually begin to move with some sustenance and duration in this direction. What better evidence than breaking through some zones of support? So my rule, I typically, as a general procedure, strategically, will have it 2 levels of support. Granted, zones of support on an hourly are not as significant as zones of support on a longer time frame, such as the daily in general, but it's better than nothing. So in principle, on the assumption the market continues to move up as we get closer and closer to this time point, I will more or less look for zones of support below which I can creep or incrementally raise my sell stop that has the purpose of generating or establishing my entry if it's triggered. More or less, you want to keep that a similar distance if the market moves up. If at any juncture the market comes down, well, the chips will fall where they may. If it comes down to the point where it takes out levels that previously it could not take out, then my stop is going to be sitting somewhere either under here. I probably a little more conservatively under here, you see. So this level, this higher level is 2082 in change, or roughly 2082 if you can't really, 2082. This is a little lower, 2074. Market again is at 2088 and change. Just 2088.75 is where we close Friday. So I would, in principle, if I'm planning for this, work my sell orders currently under 2 levels of support around the 2074 area. If we continue to move higher, I will adjust my stop higher, more or less with an effort, with the idea to maintain that similar spread. Now, if I'm wrong directionally completely, here's an obvious zone of resistance. And then I would go back here. Here's this, notice this top here, I should have elucidated this. If it turns out that we see a breakout, an explosive move, by Tuesday or the middle of the week, Wednesday certainly, then I have to, as I mentioned and alluded earlier at the beginning of today's presentation, a former head of state in Britain, when the conditions change, madam, what do? I change my view. But currently, this is my bias of expectation for the stock market. So I would be procedurally, possibly as early as tomorrow, if not probably be looking intensively at this market in the next few sessions, watching to see the performance as we edge closer and closer to this vertical important timepiece, for which I have over 90% confidence something transitioning or change should manifest. Right now, I'm looking more likely at exploiting the short. If so, this is how I procedurally will exploit it in an effort to work my orders by selling stop. If you're aggressive, you just go short and then identify a zone of getting out if it goes up against you. If I'm wrong on the direction of this, then we'll see it taking out like this. I'll look on the charts and see where my overhead zone of resistance is. If it breaks through 2 significant levels of resistance, then I'll give up the ghost in that sense, and to speak, and look to capitulate my short and reverse and go long. So that's a play that we will be doing in all probability within the next few sessions. Folks, it's been a pleasure. Let's see, this is the end. If we have any final questions after no, I think not. Someone's making the OJ market is ironically illiquid. Yeah, that was the point I wanted to make. From time to time, I think more time than not time. We offer incentives for signing up. I am not the only teacher. We have a number of mentors. The benefit of mentorship as I present, and some of my other coworkers, is you get the one-on-one discussion. It would be a lot less labor intensive and time intensive if I could teach and coach and provide tutelage and instruction on specific ideas, all of the features that for which I have acquired expertise in 30 plus years of this business in a group setting, but the problem I have never, and it just doesn't make sense to me on varying levels. Everyone, there's so many, this business is by definition filled with variables, and what differentiates one trader from another trader and one trading entity from another trading entity could be a multiple of complex variables. So for me to, in an instructional capacity, yeah, I'm not saying that group teach can't in some ways be beneficial. I think it's just of greater benefit and makes it an easier time to receive a premium of whatever is requisite for an individual trader to get that one-on-one. So that's what I do, and some of my coworkers as well, mentors. We have other mentors who specialize in different types of analysis. My particular area of research is market timing. I don't mean to imply that I apply in place and make my opinion solely on time. I incorporate price, but I complement my price analysis with timing. And that makes me rather in the minority of traders. But if you have further questions concerning the specifics of any of our programs, any of our speaking, or anything related to what we do at Pacific Trading, you have the contact information. The person you would liaison with internally at PTA for me is Peter Newman. Some of you who've heard me speak in the past know him and have maybe talked to him. But any questions that you have concerning any of the programs, you'd want to ask for Peter Newman at the contact information you have here. At the end of, when I sign off in a second, you can fill out the contact, your email and all that, and whatever information is required. You'll be entered into the raffle, and if you win, you get the 50% discount on the one-on-one mentorship program that I present. Or at least you can get information more about the other related programs we have. Let me one final look and see if there are any other questions. Thank you, VJ. Thank you again, Chef. Well, folks, it's been real. I've got other lines in my office going, but until next time, just as a final thought, I am probably, in light of recent events worldwide and domestically, probably a next topic for consideration that I may speak on will be the course of the US dollar. I think it's just from a fundamental standpoint, I've always said for Forex traders, and in particular, or any currency, but in particular the US, because we represent the primary power in the world today, the future course of US dollar, how the interplay with interest rates, we've got the corresponding time point target for the interest rate sector, that is the 30-year Treasury coming up this Thursday, how that, I will be curious to see how that correlates with my time target for the stock market on Monday. And I've always told people as a starting point, fundamentally, from a fundamental standpoint, if you want to consider and trade currencies or Forex or any aspect of that, you know, a starting point of just in a broad context of consideration, you know, as a nation state and goes, so too will it currency. So I always tell people, think of a currency as if, you know, if a country or a nation or a sovereign entity issued stock, its currency would be its stock. So that might be, I just thought about that last night and I said, well, we had already advertised the emotional and trading psychology seminar for today, but in the upcoming weeks or months, I may very well, especially as we see events that are sometimes extreme in our world we live in, and the corresponding repercussions and reverberations in the financial sector, and in particular, because of the US dollar standing in the world, might be an interesting topic to give you my views on from a time perspective and price perspective, also taking into account all the fundamental obvious factors. So that might be a potential topic I may speak on in an upcoming program. Until that time, folks, I wish you the best. Have a great weekend, good holiday coming up, good Thanksgiving, and wish you a very good day and profitable trading in the days and weeks to come. Until next time, have a great one.